we are witnessing right now is not a dip. It is not a seasonal adjustment. And it is not the kind of minor fluctuation that market analysts wave away at the end of a quarterly earnings call. What is happening in the American auto market right now is something far more serious, far more structural, and far more consequential than anything this industry has faced in living memory. The biggest car market crash of our lifetime has already begun. The data confirms it. The credit signals confirm it. And the wave of inventory now flooding dealer lots across the country confirms it. Auto prices, which spent 3 extraordinary years defying gravity and common sense in equal measure, are now reversing. And in the most distressed segments of this market, the correction is not going to stop until prices have fallen to levels that would have seemed completely unthinkable at the height of the boom. We are going to walk through exactly how we got here, exactly what the numbers are telling us right now, and exactly what it means for buyers, sellers, lenders, and the broader economy. Because this is a story that touches all of us. To understand the scale of what is coming, you have to understand the scale of what came before. In 2020 and 2021, a set of forces collided simultaneously that created one of the most distorted market environments in automotive history. First came the pandemic, which shut down semiconductor fabrication plants across Asia and crippled new vehicle production at every major automaker on the planet. Ford, General Motors, Toyota, Stellantis. Every one of them was forced to idle assembly lines because they could not source the chips needed to build modern vehicles. New car inventory at dealerships collapsed. Days supply figures, which normally hover around 60 or 70 days, fell below 20 days at the worst points of the shortage. That supply vacuum, in a market where millions of Americans still needed to buy vehicles, created a frenzy. At the same time, the Federal Reserve had pushed interest rates to near zero, making financing cheap and accessible. Stimulus checks were flowing into household bank accounts. Rental companies that had sold off their fleets during the early months of the pandemic were now desperately trying to restock, competing with regular consumers for the same scarce inventory. The result was a price explosion that redefined every assumption the market had ever made about used vehicle valuation. The Manheim Used Vehicle Value Index rose by more than 50% between early 2020 and its peak in January 2022. Dealers were routinely selling used vehicles at prices that exceeded the original manufacturer's suggested retail price. Consumers who needed a car had no choice but to pay whatever the market demanded. And crucially, millions of them financed those purchases at those inflated prices, locking in loan balances that bore no relationship to any rational, long-term view of what those vehicles were actually worth. That psychology, the belief that prices had found a permanent new floor, is what kept the bubble inflated long after the supply shock began to ease. Consumers, dealers, and lenders all started behaving as though the pandemic pricing era was simply the new normal. Dealerships adjusted their business models around the assumption that gross profit per unit would stay elevated indefinitely. Lenders extended credit at increasingly stretched terms: 72-month loans, 84-month loans, loans covering more than 100% of a vehicle's value, because the collateral backing those loans seemed to be holding its worth, and buyers accepted monthly payments that consumed a historically large share of their household budgets, because they had been conditioned to believe that waiting would only mean paying more. But markets do not stay distorted forever. They never have. The same cycles that inflated housing prices in the mid-2000s, that pumped up technology valuations in the late 1990s, that created the auto bubble of the early pandemic era. Those cycles always, without exception, revert. The only question is how far and how fast. The answer to that question is now coming into focus, and it is not a comfortable one. The semiconductor shortage has been resolved. New vehicle production has normalized and, in some segments, actually exceeded pre-pandemic levels. Automakers who spent 2 years scrambling to fill back orders are now building inventory at a pace that is pushing day supply figures back toward normal, and in some categories, beyond normal. Wholesale auction prices tracked by indices like Manheim and Black Book have been declining for consecutive months. The pace of that decline has been accelerating. Dealer lots that were bare in 2021 are now filling up faster than retail demand can absorb the supply. Incentives, the manufacturer discounts and financing deals that disappeared entirely during the shortage era, are returning to the market at levels not seen in years. And interest rates, driven sharply higher by the Federal Reserve's inflation-fighting campaign, have pushed the average monthly payment on a new vehicle loan to record highs, pricing out a significant portion of the buyer pool that drove the pandemic-era boom. The market has turned. That turn has already started, and the data leaves no room for argument on that point. Now here's where the story escalates, because the price decline phase of this cycle is only the first layer of the problem. The deeper issue is what is happening inside the loan portfolios that were built on the foundation of those inflated prices. Subprime auto loan delinquency rates have been climbing steadily, and the trajectory of that climb has begun to concern even analysts who were relatively confident about the market's ability to absorb a correction. Fitch Ratings and other credit monitoring agencies have flagged the rising rate of auto loan balances that are 60 days or more past due. The borrowers most affected are concentrated in exactly the segment that lenders most aggressively pursued during the boom. Lower income households who were extended loans at elevated rates to purchase vehicles at peak prices, often with minimal down payments and repayment schedules stretching out to 7 years or longer. Those borrowers are now caught in a trap. Their vehicles are losing value faster than they are paying down principal. Their monthly payment obligations are consuming an unsustainable portion of household budgets, already squeezed by elevated rents, rising insurance costs, and persistent inflation across essential categories. They are in negative equity, meaning they owe more on the loan than the vehicle is currently worth, and that gap is widening every month. When borrowers in that position reach the breaking point, they stop making payments, and when defaults reach a critical mass, the repossessions begin. Repossession volumes have already been rising, and this is the mechanism through which a used car price correction can become something far more severe than a simple market adjustment. Repossessed vehicles flow into wholesale auction lanes, adding supply to a market that is already oversupplied. That added supply drives prices lower. Lower prices mean more borrowers fall deeper into negative equity. Deeper negative equity produces more defaults. More defaults produce more repossessions. More repossessions produce more supply. It is a feedback loop, and once it gains momentum, it is very difficult to stop. This is the dynamic that underpins the most alarming price forecasts being discussed in automotive finance circles right now. When you model out the combination of organic price correction, repo-driven supply floods, distressed fleet liquidations, and demand destruction caused by rate-sensitive consumers stepping back from the market, the numbers you arrive at in the most stressed asset categories are genuinely extreme. Certain over-leveraged EV models, High mileage fleet units and auction grade repossessed inventory are already experiencing price collapses that would have seemed impossible 2 years ago. In the most distressed corners of the market, the mathematics of forced liquidation can absolutely produce declines in the range of 80 to 90% from peak values. That is not a headline designed to shock. That is the arithmetic of what happens when inflated collateral meets forced selling in an oversupplied market. The electric vehicle segment deserves specific attention here because it represents the most extreme version of this dynamic. EVs were the darlings of the pandemic buying surge. Certain models carried waitlists measured in months. Dealers marked them up by 10, 15, even $20,000 above sticker. Buyers paid those premiums without hesitation, confident that the combination of fuel savings, government incentives, and cultural cachet would protect their investment. What happened instead is a case study in how quickly speculative premiums can evaporate. Manufacturer price cuts, led most dramatically by Tesla, which slashed prices repeatedly and aggressively, compressed the residual value of used EVs across the entire segment almost overnight. Tax credit changes created wild swings in the effective cost of new EVs, further distorting used market pricing. Battery technology uncertainty made buyers hesitant to pay premium prices for vehicles whose powertrain components might be obsolete within 5 years. The result is that used EV depreciation curves in certain models and vintages have become among the steepest ever recorded in the automotive industry. And the stress is not confined to consumers. Dealers who built their operations around the high margin environment of the pandemic era are now facing a structural reckoning. Floor plan interest, the cost of financing vehicle inventory, has surged alongside the broader rise in interest rates, meaning dealers are paying significantly more to carry the inventory that is now sitting on their lots for longer. Gross profit per unit has compressed dramatically from the extraordinary highs of 2021 and 2022. Dealers who overexpanded, who bought inventory at peak prices on the assumption that the market would stay strong, are now facing holding costs that are eating into margins that are already shrinking. Some of them will begin liquidating aggressively, and aggressive liquidation by dealers adds yet another stream of supply to a market that does not need more supply right now. The macroeconomic backdrop makes all of this worse. Household balance sheets, which benefited from pandemic-era stimulus and asset price inflation, have been deteriorating. Savings rates have fallen. Credit card balances have risen to record highs. The cost of housing, whether owned or rented, has remained persistently elevated. Insurance premiums, including auto insurance, which has seen some of the sharpest rate increases of any consumer expense category in recent years, are putting additional pressure on the monthly cost of vehicle ownership. All of these pressures are converging to reduce the pool of consumers who can afford to enter the auto market at any price, let alone at prices that are still, even after recent declines, well above pre-pandemic norms. Historically, the auto market has served as one of the economy's most reliable leading indicators. When auto sales slow, when financing tightens, when defaults rise, those signals have consistently preceded broader economic slowdowns. The industry touches manufacturing, steel production, rubber and plastics, advertising, financial services, insurance, and employment across hundreds of ancillary sectors. A sustained contraction in automotive activity does not stay contained within the automotive sector. It radiates outward. So where does this leave us, and what should we actually do with this information? If you are thinking about buying a vehicle, The message is clear. Patience is now a financial strategy. The buyer's market that is forming will offer opportunities that have not existed since before the pandemic, but only for buyers who are disciplined enough to wait, to avoid overpaying for hype segments, and to focus on true depreciation value rather than inflated asking prices. If you already own a vehicle with a loan balance that exceeds its current market value, the worst thing you can do right now is to make a reactive decision. Understand your position. Know the gap between what you owe and what the vehicle is worth. Do not take on additional financing that compounds the exposure. And if you are watching this market from a financial or investment perspective, the signals to watch are delinquency rates, wholesale auction spreads, repossession volumes, and the performance of auto loan asset-backed securities. Because those are the data streams that will tell you how deep this correction is going to go before gravity finishes its work. The storm that is moving through the auto market right now is not arbitrary. It is the predictable consequence of a bubble that was allowed to inflate far beyond what any rational valuation framework could justify. In a lending environment that should have been far more cautious than it was, fueled by conditions that were always temporary and always going to reverse. Bubbles do not deflate gently. They correct with the same force they inflated with, and sometimes with considerably more. The direction of this market is now unmistakable. The data has spoken. The credit signals have spoken, and the lots full of sitting inventory have spoken. What comes next is not a question of whether. It is only a question of how far.